Welcome, everyone. All right, today we're going to take a big step beyond the basics of bookkeeping. The debits and credits that you've probably learned. We are stepping into the world of managerial accounting. And here, our focus completely shifts from just recording what happened in the past to actively trying to shape the future. We're going to explore how accounting isn't just some boring compliance thing, it's actually the language that drives business strategy and the big decisions that get made in the boardroom.
So let's kick things off with a foundational, almost philosophical question that really gets to the heart of what we're talking about today. Is accounting an art, or is it a science? Well, the science part is pretty clear, right? It's governed by very strict rules and standards. You've probably heard of JAP, the generally accepted accounting principles we use here in the US, or IFRS, the international standards. There is a right way and a wrong way to do things. But its real power, the thing that separates a simple bookkeeper from a strategic financial partner, that lies in the art of it. The art is in the interpretation, the analysis, and most importantly, the communication of the story that all these numbers are trying to tell us.
So here's our game plan for today. First, we'll get a solid handle on accounting's strategic role. Then we're going to introduce a really powerful tool, the cost, volume, profit framework, and we'll use it to calculate the super important break-even point. From there, we'll apply these ideas to a real-world business decision, focusing on how you actually communicate your findings effectively. And to wrap it all up, we'll see how these same tools help us forecast and plan for the future.
Okay, let's dive right into our first section. Here, we're going to pin down exactly what we mean when we talk about accounting in a decision-making context. Believe me, it is so much more than just balancing the books.
This definition right here is key. Let's really pull it apart. To record, that's the day-to-day stuff, journaling transactions. To classify means we organize all that chaos into meaningful buckets like revenue or expenses. To summarize is when we bundle all that data into the financial reports, like an income statement. But that last verb, analyze, that is where we are going to live in this class. That's the magic step. It's taking all that summarized data and turning it into real intelligence that helps people, managers, investors, you name it, make smart, informed choices. So the crucial point here is not to see this as just a checklist. Think of it more like a domino effect. It all starts with a clean, accurate record of every single transaction. That's what keeps you legally compliant, and it's the raw material for your financial reports. And those reports, they create transparency, which builds trust with investors and banks. And all of this leads to the final domino, empowering management with reliable data. Without that solid foundation, any decision you make is really just a shot in the dark. But with it, your decisions become calculated, strategic moves that are grounded in reality.
All right, let's move on to our first major analytical tool for the day. I want you to think of cost volume profit analysis, or CVP for short, not as some complicated formula, but as a financial GPS for a business. It tells you exactly where you are, it helps you map out a route to where you want to be, and it shows you what happens if you decide to take a few detours along the way.
At its core, CVP analysis lets us answer a whole bunch of critical what-if questions. What happens to our profit if our material costs jump by 5%? How many more units do we have to sell to make it worth hiring a new employee? If we're aiming for a target profit of, say, $50,000, what's the sales volume we need to hit? It's a surprisingly simple but incredibly powerful model. But to use it, we first have to become masters of the two different types of costs.
Now, this is an area where I see students get tripped up all the time. So let's be crystal clear about this. Fixed costs are the costs you have to pay whether you make one product or 1,000 products. Think of your monthly rent for the factory, or the salaries for your admin staff. They're fixed. On the flip side, variable costs are tied directly to production. The best example is raw materials. If you want to make one more product, you need more raw materials. The key takeaway? If you produce 0 units, your variable costs are 0, but you still have to pay the rent. That's the fundamental difference.
And this brings us to a really vital concept, the contribution margin. The name itself tells you what it does. It's the amount of money from each sale that's left over to contribute to covering all those fixed costs. Now listen, this is not profit. That is a critical distinction. Think of it like this. Your fixed costs are a giant mountain you have to climb over each month. For every single item you sell, the contribution margin is the cash that helps you take one step up that mountain. Once you get to the top, once your fixed costs are totally covered, every contribution margin dollar after that flows straight to your bottom line as pure profit. It's literally the engine of profitability.
Okay, so now let's use this CVP framework and what we know about costs and contribution margin to calculate one of the most important numbers for any manager or entrepreneur out there. We're talking about the break-even point.
This is the fundamental question that break-even analysis answers. It is the point of perfect balance, where your total revenue exactly equals your total costs, both fixed and variable. It's your absolute minimum target. If you're below this point, you are losing money, period. If you are above this point, you are making money. Knowing this number is the absolute first step in setting any kind of meaningful sales goal.
Now let's just take a second to appreciate the beautiful logic of this formula. Don't just memorize it, I want you to really understand it intuitively. Think about it. You've got this big pile of fixed costs you have to pay no matter what, that's the numerator, and for every unit you sell, you get a certain amount of cash to help pay down that pile. That's your contribution margin, the denominator. So the formula is just asking a simple question. How many of these little contributions do we need to completely cover our big pile of fixed costs?
Okay, let's walk through a calculation together. Imagine a simple little business. First, we figure out our total fixed costs for the month. Rent, salaries, the usual. Let's say it's $10,000. Next, we know we sell our product for $50 a pop, and we've calculated that the materials and labor for each one, our variable costs, are $30. Step 4 is the big one. We calculate our contribution margin. So $50 in revenue minus $30 in variable costs gives us a $20 contribution margin per unit. And finally, we just plug it into our formula. $10,000 in fixed costs divided by that $20 contribution margin.
And there it is. This company has to sell exactly 500 units in a month just to break even. At 500 units, their total revenue will be $25,000, and guess what? Their total costs will also be $25,000. It's a perfect match. Now, the sale of unit number 501, that's where the magic starts. That's the very first sale that generates actual profit, and every single unit sold after that adds a full $20 straight to the bottom line.
Okay, so we've got the mechanics down, but let's see how this actually plays out in a real-world scenario. Because in business, the numbers are never just numbers on a page. They are the foundation for debates, for decisions, and for strategy.
So here's the situation. Picture this. You are the analyst for a local coffee shop. The marketing manager comes to you with this big idea. They want to switch to a new, fancy, ethically sourced coffee bean. I mean, it sounds great, it aligns with the brand, it feels like the right thing to do, but these beans are going to increase the variable cost of every single cup of coffee you sell. So the question for management becomes, is it actually worth it? How do you, as the numbers person, help them make that call?
And this, right here, is where the art of accounting really shines. It is not enough to just calculate the right answer. You have to be able to communicate that answer in a way that's clear, that's persuasive, and that leads to an intelligent conversation. This is where we go from calculation to communication.
So let's imagine we're in the meeting. The marketing manager, full of passion, makes their pitch. They say, this move is going to be huge for our brand. It sets us apart, we can totally absorb the tiny cost increase, and our customers are going to absolutely love us for doing this. It's a valid point of view, right? It's rooted in brand and customer feelings. But right now, it's based on intuition, not data.
So you, as the analyst, you don't argue with their passion. You present data. You just put this simple bar chart up on the screen. Let's say our old break-even was 500 cups a day. Your new calculation, with the more expensive beans, shows that the new break-even point is 800 cups a day. That chart instantly makes the impact visual. This isn't some small cost we can just absorb. It means we now have to sell 300 more cups of coffee every single day just to get back to zero.
And this is how you do it. This is how you communicate professionally. Notice the language. You don't say, that's a dumb idea. You start with the data. The numbers show, you quantify it, it increases our daily break-even point by 60%. And here's the most important part. You frame the decision that the team now has to make. You give them the strategic options. Look, we either have to raise our prices or we have to be really, really confident that this move is going to bring in 60% more customers. You've just turned an emotional pitch into a data-driven strategic choice.
Which brings us to our final section. You see, the break-even analysis gives us a snapshot of right now, but its real power is unlocked when we start using it as a dynamic tool for planning and forecasting what comes next. So, the crucial point here is that CVP analysis isn't something you calculate once and then just file away. No, it should be a living model on your spreadsheet. You can use it to run all kinds of scenarios. What happens to our profit if we raise prices by 10%? What if we find a way to cut our fixed costs? We can use it to set sales targets for our team that are actually based on reality. We can even use it to figure out if launching a whole new product is a good idea. It becomes this central tool for navigating the future.
And that is the final thought I really want to leave you with today. The tools we've discussed, CVP and break-even analysis, they are absolutely essential. They give you the map. They show you the financial terrain.
where the mountains of costs are, and how much ground you have to cover just to get to safety. But they don't tell you which direction to travel. Accounting provides the map, but leadership, strategy, brand, and a deep understanding of your customers, that is what determines the destination. Your job as a future leader is to become a master at reading that map